Welcome to Money Matters. My name is Paul Mitchell. I'm a Vice President with Beneficial Bank. I'm your host today. With me is Adam Newman, who is your co-host. Adam is the Vice President of SFG Wealth Planning Services, Inc., part of SFG Investment Advisors, Inc., and SEC Registered Investment Advisor. Welcome, Adam, to the show.
Hey, thank you for having me, Paul.
You have quite a background. So
That's
as a
right.
wealth advisor, you advise people on managing their wealth, I assume.
Absolutely. So we work with primarily public and private corporate executives, advise them around all matters related to their stock-based compensation and other wealth planning needs. So that could be retirement, issues around taxation, insurance, and last but not least, investment management.
That sounds like quite a lot. What are some important considerations when determining what percentage of your portfolio you should hold in stock these days?
Well, first and foremost, and it's somewhat cliche, you want to focus on your goals. Why are you investing this money? There's a particular reason why you've chosen to put money at risk versus hold it at the bank in cash, especially today in the low interest rate environment. So you have to identify, why am I putting this money to work? From there, there's really a second layer, and that's where you need to start to quantify things, and that is you want to look at your ability to take on risk and your willingness to take on risk with that money.
Sounds pretty psychological at that point.
It can be. So your ability to take on risk is purely quantitative. So that's when you're looking at your basket of resources relative to your goals. How much money am I going to need at X date in the future, and what rate of return do I need to generate? So that's the numbers side of things. Your willingness to take on risk is, to your point, purely psychological. What's my investment gut? So there's many periods, especially in times like 07 to 09, where you see very precipitous drops in the market, and people are they wake up one day and realize maybe I was taking more risk than I should have.
Yeah. So today, 60-40, 70-30, how does that work?
Yeah, and that's really the loaded question, and that's why you need to really look at those two factors, ability and willingness, because you may need to take on a certain level of risk if you want to achieve your goals long term. You may not need to. So one tool to use when you start to look at risk and you start to think about how much of this money that I'm investing am I willing to lose. A very general rule of thumb that someone could use is, if you take whatever percentage you're going to allocate to stocks, say it's 60% to your example, if you divide that by 2, historically, that tends to be the worst year of a loss in that type of portfolio in percentage terms. So the worst year for a 60-40 portfolio is roughly 30%. The worst year for a 100% stock portfolio can be around 50%.
Wow.
So that's just something to think about when you're looking back on time and saying, how much risk do I want to take?
Why is it so important to look at time horizons in making your investment decisions?
Well, I think it's really simple. I mean, the markets are volatile. You never know when things will be moving up or down, although we do know over very long periods of time, 10, 15, 20 years, the market historically has trended upwards. If you have a shorter term time horizon, say 1 year, 2 years or less, you could be putting money to work at an inopportune time. So if you need funds in a year, 2 years, and we see a 20% dip in the market, the likelihood of you recouping those lost dollars is less and less likely as that time horizon shrinks.
Wow. So what are some of the most important criteria for adding an investment to your portfolio?
So you determine what type of allocation you'd like to have in terms of stocks to bonds. You know what type of risk you'd like to take. And then you really need to determine from there what basket of investments I'd like to hold, what basket of securities. And when you're looking to add or subtract anything from that portfolio, you need to understand how everything works together. It's kind of like, cooking. You might have this really fantastic ingredient, but when it's combined with, these other ingredients, maybe the recipe is ruined and you don't want to eat it anymore. The portfolio can be the same way in that you might be adding something to the investment mix that might increase the volatility, that might cause you to be overweight in a certain sector or certain.
That sounds complicated.
Yeah, and it certainly can be, and that's why you really need to find a way to look under the hood of your portfolio, and a lot of times someone can help you with that.
I've heard some of these terms like passive investing and active investing. What's the differences there? How does that work?
That became really popular back, after the big dip in the market in 07 to 09 because a lot of the funds that were active had underperformed the general market significantly.
So what does active mean in that case?
So when you hire an active manager or you employ an active management strategy, you're going out and you're picking individual stocks or securities and saying, I think these are the winners. When you're passive, you buy a broader basket of securities, and the greatest example of that is the S&P 500.
Sure, index funds or something.
Exactly.
Yeah.
Indexing is the best and most prominent form of passive investing.
So how can both types of management strategies be used to lower costs and possibly improve long-term returns?
Well, when you look at the debate of active versus passive, it tends to be, black and white. There's two schools of thought. One thinks you should be all passive, and the other thinks you should be all active. We kind of land somewhere in the middle in that at any given point in time, there might be certain segments or asset classes where active might be more favorable than passive or vice versa. So in an area like the U.S. stock market, when you've seen this, huge run-up and we've had really 5 great years in a row, you might want to employ a passive strategy in saying that, we think the market's at this certain level and maybe may or may not be more room for more growth. But in other parts of the world, say emerging markets like Brazil, India, China, and Russia, where you've got other factors like, politics, regulatory, liquidity issues, you might want to get into more individual security selection to try and improve your overall returns.
So what's your view on the state of the economy? Stock market has been, like I said, doing pretty well. Is the economy really doing that well? Is that a good reflection of the economy, or is it a little more isolated?
Well, right now I think it's a tale of two stories. You've got the U.S. that's really had a robust market and a slowly recovering economy, and right now we're at the point where things have been going so well on the market for so long, and the economy isn't quite humming at the pace that you would think it should be, given where the market is. Other parts of the world, and particularly Europe and Japan, the markets have really underperformed the U.S., but overall, their economies haven't been as strong. So if you're looking into the future, where could there be possible sources of future returns?
Right.
You want to look to that. Yesterday's underperformers can certain times in the future be tomorrow's outperformers.
What's the impact of interest rates do you think are going to have on the economy and, I guess, the stock market itself?
If you look historically, the 6 to 12 months preceding an interest rate hike, the stock markets tend to hold up, fairly well. We know what happens when rates rise and you're holding a long-term bond. That's typically never a good thing. But in terms of the stock market, it historically would signal that a rate hike and a growing stock market are kind of move hand in hand.
In my business, banking, and I deal mostly with small and medium-sized businesses, there's a lot of talk about the impact of interest rates on what's a business going to do. But actually, in the last couple of years, even with lots of parts of the economy doing very well, there has been sluggish demand for borrowing for these businesses. They don't seem to be investing in the future as much as one would think.
And how about the regulatory environment? Has that played into that supply-demand equation at all?
Absolutely. The cost of compliance, number one. Just a feeling of somebody always looking over your shoulder, even if you're a very experienced banker in a very stable bank, you're not making all the decisions on your own. So there's a little more of a hesitancy. Certainly most banks, but every bank I know, if it says, boy, we are out lending money, we want to lend money, we have money to lend, but the growth is it's been sluggish.
And when you think about the current interest rate environment, obviously we know that rates are likely to go up, versus down. And you look overseas to a place like Europe where they're employing negative interest rates and they're actually fining, people for holding cash.
Right.
What are your thoughts on that? Is that something that we would ever see?
Well, I think we came pretty close sometime in the last few years. I forget exactly when, but there certainly was talk of that. I think the number one thing that it says to me is the U.S. is still the best place to be, to do business, to live, to raise a family, in terms of stability, strength of the economy. All the negative talk of years of Europe and some of these socialist type countries taking care of the people better and that type of thing. They're having real big problems, just like you're saying.
Sure. And what do you think about, you hear a lot, especially in the Wall Street Journal in the past, couple of weeks, there's a lot of talk about IPOs and companies,
Yeah.
going public to raise cash. And some of the argument you see here is they sometimes have difficulty finding short-term cash for lending needs. Are you seeing any private companies, small or mid-sized private companies, having difficulty finding loans?
Yes, but the main criteria is, do they deserve credit? I mean, the lending business is actually quite simple. All we have to do is see cash flow to service the debt. We need collateral. We need a second sort of backup source of repayment if things don't work out so good, and a story that holds it all together. If a company cannot demonstrate that it's been profitable, that it has the cash flow to service the loan, it's not a loan. They need equity investment.
Sure.
Or something like that. It's a riskier type of
right.
Of financing.
Absolutely.
So I still have a couple of situations right now that are very exciting in some very basic industries. Good management. Number one. Good management in an industry that's out of favor. Terrific. Diamonds in the rough. Things like that.
Fantastic. So what about when you look at the regulatory environment, you look at interest rates, if you look out the next 12 months or next year, 2 years in the future.
That's as far as I'm going to try to look at, sure.
Yeah. So what do you think about rates? Do you think if we were sitting at the table this time next year, are we going to be in a higher rate environment?
Well, I guess I can't really use my opinion per se. I can sort of quote or digest things I read. Yeah, definitely. I think that there's one way of saying it would be, if the interest rates go up maybe 1% a year the next couple of years, still would be, relatively speaking, in the last 30 years, a low interest rate environment. So I would, and things aren't going to be that stable. I wouldn't be surprised if there's some jump, but I'm not going to talk about I think 10 or 11% rates or something like that.
Sure.
But if a home mortgage is 6 or 7%. That's still a pretty good deal.
Absolutely. Yeah.
We've been spoiled with 2.5 or 3.5%.
Sure.
So I think with a stronger economy and wages go up, so we need that to service more debt. So, but that takes me to our question from our viewers. We always have one of those. I think, Adam, this one is I think right up your alley.
Wonderful.
Robert Mentor of Exton says, "Where do you see good growth in stocks today?"
Okay, great question, and one we've heard for many of our clients. One of the things that I'd say to Robert is, we've come through this period of a great and robust U.S. stock market. Right now is the time to step out of what we call a home bias, and look at other parts of the world for investment opportunities. So you look at the U.S. and a lot of people are feeling uneasy in that, I need to look for growth because we've had this great, 6-7 year run.
Right.
So you want to look other parts of the world for investment opportunities. There's places like Europe and Japan in particular where certain companies, and even broadly speaking, are looking at double-digit, revenue and earnings growth over the next, 2-3 years. Yeah. So there are certainly investment opportunities, but you've got to look outside of the U.S.
Yeah.
And that entails more risk. So you got to wonder how that fits into your overall portfolio.
Sounds like it also takes more research.
Yeah, absolutely.
And also, you've got to look at the individual company, not just it's a good-sized company in some European country.
Yeah, absolutely. There's different risks involved in investing overseas, but at the same time, it still can present some very attractive opportunities.
Good, interesting advice, Adam. Thank you. If you would like to ask Money Matters to answer your question, here's how to do it.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, M-O-N-E-Y, -matters, M-A-T-T-E-R-S, TV.com.
Hello. Our featured guest this evening is Tom Aiken. Tom is managing partner of Cedarwood Partners, LLC. Welcome, Tom. Thanks for coming to the show.
Thank you, Paul.
So you've got quite a financial background, I understand. Adam, I think, had a question for you that you'd like to
absolutely.
start off with.
Tom, tell a little bit about Cedarwood and what you do.
Well, Cedarwood Partners is a business advisory firm that provides a high level of financial leadership solutions through outsourced financial services, such as outsourced CFOs for emerging growth companies that have a need for a strategic CFO, which they might not have or might not need on a full-time basis.
Tom, tell us a little bit about your background, how you came to form Cedarwood.
Well, I've had Paul. I've had 30 years experience as a CFO in public and private, privately owned technology companies, both manufacturing and software. Through that experience, I've done a lot of debt financing, equity, IPOs through initial public offerings. I've had a lot of merger and acquisition experience on a multinational level. I've been involved in turnaround situations, and through those 30 years I've gained a lot of experience that I wanted to take the opportunity to share those experiences with emerging growth companies and help them through the technical difficulties and the challenges of growing businesses. So in 2013, I founded Cedarwood Partners, and after providing those services for about a year, I also aligned myself through an affiliation with J.F. Smith Associates, which is also a management consulting firm, to round out the different disciplines that we could bring together to our clients.
Interesting.
So with your great background and your broad service offerings, especially focusing on, as you mentioned, emerging growth companies, what particular industries are you serving?
Well, actually, as my experience was with technology companies, I find that the problems associated with one industry are often the same problems with all industries. Our client base range from clean tech to biotech to nonprofits, heavy manufacturing, software companies. It's a full, it's a broad scope, and a lot have identical types of problems.
So what size companies would these be, I guess, in terms of revenues or number of employees, things like that?
Revenue usually runs between $1 million up to as much as $75 million. Again, a lot of it has to do with the management team that they have, the growth rate of which is being incurred, and whether they need the type of strategic services that we provide. In many cases, these companies will have a controller or a CFO that's very technically competent from an accounting perspective, but they need that strategic experience to help them with other business related issues.
Interesting.
So you'd mentioned before, regardless of the industry, you tend to find common issues across various companies. So would you mind delving deeper? What type of issues do you see as common?
Sure. Well, we see anywhere from being able to accurately make their financial projections, putting together investor presentations to raise equity, looking at restructuring bank debt, for example. That goes across all industries. Yeah.
Could you give us a few examples of some of the projects you've worked on, and in particular, maybe one or two like real success stories, or here's what Tom Aiken did for this company?
Sure. Well, I like to think that they've all been success stories. So, but we've done everything from brought in to do assessments of financial organizations and processes and systems. We've filled interim CFO positions during interim periods where they're between CFOs. We've helped companies put together financial projections to acquire bank financing.
Sure.
Been brought in by boards of directors to help and support the CEOs in making strategic decisions relative to acquisitions. All of those have been successful.
So you find some banks that put a lot of credence in projections?
Well, let's say this. You know, one of the things that I tell these clients is that not only do they have to know where they've been, and they have to have an idea of where they're going, how they're going to get there, and what those milestones are going to be that they're going to achieve.
Yeah, I've had companies say, "Well, Paul, why should we do projections? We don't have a crystal ball. We can't predict the future." I go, "It's a tool. It shows a banker what your thought process is, you know, and what the ups and downs might be, that type of thing. If you're going from $1 million in revenues to $1 billion in revenues, probably nobody's going to believe you." So
That's right.
it is a good exercise.
Yeah, and it's a matter of spending the effort and the time to put together a plan that you and your management team believes in.
Yeah, ownership of it. Sure.
That's right.
Yep.
How about nonprofits? Does Cedarwood work with them?
We do. We do work with nonprofits. We've done some interim CFO work with large nonprofits, as well as assessments of financial organizations and the processes. Yes.
What's going on with the changing role of the CFO these days? I see a lot of that in the newspapers. What does it mean?
Well, the CFO was the accountant, right? And
Chief Financial Officer.
Chief Financial Officer. It was the accountant. It was the individual responsible for the finances of the company. And what's happening now is that position is evolving into more of a strategic management position, where the CEO and the board of directors, rely on the CFO to bring forth, other experiences and other talents, not the least of which is working on their strategic planning, on whether it's IT related matters or whether it's human resources. Acquisitions is a big play now for CFOs, so it's evolved to a lot more, and that's where we see a lot of our business coming from, is that the individuals in those emerging growth companies may not have the experience, and we can assist them and support them in that manner.
So, as a CFO, provide that type of advice. What's your opinion of interest rates?
Interest rates
and the impact on companies you work with.
Where we are right now, I think I'll agree with what you said, that even if the interest rates go up a point or two over the next year or so, it's still a good deal.
Yeah.
The issue that I see is there's still the uncertainty in the companies and the slower growth, having been burned, during this last period of time.
I think that's what's happened. Yeah.
They're slow because they've done a lot of work in this area, in trying to reduce their costs, increasing their profitability, and the last thing they want to do is put themselves in a position where they're going to be in trouble again.
Yeah, vulnerable to changes and things that they don't have control over can change and impact them.
That's right.
So Tom, what advice would you have for early stage companies?
Well, I have, I guess, a couple pieces of advice, and one is relative to Paul, is to form those banking relationships early, before you need the money, and work with your banker so that they understand where you are and they're part of your team. So when you need the financing, it's going to be available.
Yeah.
Right. And the other thing I would say is create those dashboards and those scorecards and track your performance against your milestones, and take them in small bites, and you'll be much more successful.
Metrics, yeah.
That's right.
Yeah. So when you deal with different sized companies, does the size of the bank make a difference that you're introducing them to or making a presentation for? Or, I mean, if it's a $70 million company, you should be dealing with a big bank, and if it's a $1 million company, you should be dealing with a small bank. Is that significant?
I think what's more significant is what the bank's appetite is for a particular industry segment, I think certain banks would be perhaps more interested in certain vertical markets, and it becomes a matter of finding the right fit that they both have the experience, they both understand that industry and what the expectation should be. Yeah.
Interesting. Yeah. So I think sounds like your advice would be that the company should talk to a bunch of different banks to find that out, because
Absolutely.
you listen to the commercials or read the advertisements. They kind of all say the same thing. We're a relationship bank. We know your business, et cetera, et cetera.
That's right.
But I think there's more legwork is needed.
Absolutely.
How about besides preparing yourself to talk to a bank, would you recommend that most companies have at least maybe two banks to deal with, maybe one main bank and maybe another one they have an account with, and have some kind of relationship, either just in case or kind of as a check on what's going on in banking or something like that? Is that important these days?
I mean, I think it's good to have more than one bank. Now, to the extent that can be accomplished, might be something different, because I think the banks look for all the business to be within their institution. But that doesn't mean that you can't work with other banks to keep them abreast of what you're doing, abreast of the industry, abreast of your successes, as well as perhaps failures along the way, but keep them involved so that if the time comes that you need them, they'll at least be up to speed. They'll know the industry, the business, and the management.
Since I'm a banker, I have to ask you this question. So what do your clients say the worst thing that banks do, or I hate banks because of?
They'll say that they hate banks because the banks are only interested in loaning them money when they don't need it.
Well, that sounds like a pretty good conclusion. So, well, it sounds like your years of experience are really valuable to the companies you work with. That's you've seen a lot, ups and downs, in lots of different companies and industries, and that's just terrific.
Yeah.
So, thank you very much, Tom.
Right. Thank you.
And Adam.
Thank you.
Thank you.
So, that's the conclusion of our show, and I just want to let you know that here, your money matters.